Well, we're half an hour from the open in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Stephen Engle with Yvonne Man.
Our top stories this morning: TSMC shares in focus after the company's earnings hit a record. The Taiwanese chipmaker also hiking its forecast beyond the loftiest expectations.
Asian stocks, meanwhile, following Wall Street higher after fresh data pointing to resilience in the U.S. economy. Investors also cheering calls by Fed officials for rate cuts this month.
And the U.S. imposes tariffs on graphite from China, threatening to restrict the supply of a key mineral in EV batteries. All right, it looks to be a pretty happy Friday here. If you're long these risk assets, you take a look at how U.S. futures go. We hit yet another record in the U.S. overnight as well when it comes to the S&P. And Asia is feeling it a little bit here. We're slightly up about a third of 1%. But Taiwan is really the focus here this hour after that TSMC results that we saw after the close yesterday, right? We saw the ADR surge. We're seeing that right now in the Taiwan shares up more than 2%. So they're guiding higher there when it comes to their forecast of sales from mid-20s to about 30% now. So certainly that was important for the market. And CC Wei talking about this demand in AI remains strong. We'll talk about the FX impacts later on, but certainly that is why we are seeing the TAIEX up 1% at the get-go here. So we'll continue to watch the chip space here this morning. Obviously, the NVIDIA story continues on as well. We did see NVIDIA up overnight. Also, you take a look at how the dollar is concerned, though. We're slightly on the back foot, but we're still set for basically 2 weeks of solid gains for the greenback here. That U.S. data print, as Steve mentioned, right? Retail sales was strong. We saw a 5th straight month of jobless claims that decline. Goes to show maybe the data is still looking pretty strong here right now. And what does this mean for rate cuts, right? It seems like the Fed officials are still quite divided. We'll talk about Waller in a second, though. He's probably the few that really has stuck his neck out and saying, look, maybe a July cut is justified. We'll see, right? 30-year yields in the JGB market still seeing a slight stabilization there, but obviously with the upper election coming through, we're going to be focusing very much how long rates perform. That inflation print out of Japan also didn't quite ease those concerns about stagflation in Japan. Bitcoin, we're watching very closely. We're just inching back closer to that 120 level there. Of course, the big thing that we saw in the U.S. was this legislation, federal legislation to regulate these stable coins. That certainly gives another lift maybe of more adoption into the space as well. China futures are doing this here right now as we wrap up a pretty good week in terms of Chinese equities. We're still seeing futures in the green here this morning, 7.18 for dollar China, and we're watching a little bit of the weaker dollar, the honky dollar there. We briefly saw a bit of a surge and maybe moving away from the weaker end of that trading band, but we're still hovering on that 784.90 level, Steve.
Well, happy Friday, Yvonne, and to everyone else out there as well. We don't go a day without talking about chips. TSMC has raised its revenue growth outlook for the year, boosting investor confidence in the global AI spending spree. CEO CC Wei says while AI orders remain strong, uncertainty around the Trump tariff requires caution.
We also see AI demand continuing to be strong, including the rising demand from sovereign AI. Therefore, we now expect our full year 2025 revenue to increase by around 30% in US dollar terms. Amidst the uncertainties, we will remain mindful of the potential tariff-related impact and be prudent in our business planning going into second half 2025 and 2026, while continuing to invest for the future mega trend.
So for more context, Bloomberg Intelligence senior analyst is here, Jen-Hsun, with the latest. So you got those results, you got the guidance. What does it tell you about AI demand, and was it in line with your expectations, better, worse, what?
I think overall the company raised their guidance for full year. That alone basically is a strong evidence that the AI demand remain pretty strong. And then the market concern on the like currency side or the overseas ramping operation, they did have some impact on the margin, but the company performed very well to basically they managed to offset that with their better product mix and also better execution. So they still deliver very solid margin. But obviously that will remain the potential concern in the second half. Yeah.
It seems to imply that despite raising that full year guidance, that sales will be softer in the fourth quarter. Is that how you interpret it too?
That obviously appears to be the case. The management, the CCWA did say that they prefer to stay that way given the ongoing uncertainty related to tariff. And to some extent, I think that also maybe reflect the potential sort of consumer weakness in Q4, given, again, the macro uncertainty there. Yeah.
So how does the tariff scenario play out for the second half? You mentioned about the potential headwinds into the second half. So this guidance goes forward. It's positive, but how long does that positivity last?
Obviously, Q3 will still look pretty solid. And then the tariff thing is really more about its uncertainty as opposed to the actual magnitude of the tariff rate. Particularly, we're talking about there's a potential tariff for semiconductor itself, which is still unknown at this point.
In addition to the country-specific, there's sectoral.
Exactly. So, again, there's a lot of uncertainty there. But from the company's perspective, I think AI demand alone has been very strong, even though the consumer has been somewhat soft, and also the company's capability to manage their margin, as we mentioned. And also, I think the company does have a very good pricing power. The management didn't highlight that particularly, but I think is it possible that the company may manage to pass on part of the pressure to its customer, which is possible.
Stephen, thank you, Stephen Sung there, our Bloomberg Intelligence senior analyst on TSMC. We're going to continue digging into those earnings. We got Murray Asset Global Investments in the next hour plus. You don't want to miss this one. We're going to hear later from the TSMC's senior vice president and CFO Wendell Huang speaking exclusively to Bloomberg about that guidance and tech tensions between the U.S. and China. He specifically, Steve, also mentioned the FX and the currency headwinds moving forward, given what we've been seeing in the Taiwanese dollar, too.
Yeah, that's right. And I just find it fascinating to see, coming up to this Fed meeting coming up, in a week or so, 2 weeks, Michelle Bowman and also now Waller possibly saying we need a cut, right?
Yeah, is it justified, right? Right now, when you take a look at how the labor market still remains quite resilient, when you take a look at, you're starting to see some tariff pass through. Yeah. That's starting to bite, but not quite, right? And I think Waller's case is, you can't wait until the labor market weakens. Before you actually cut rates. So that's his argument here right now as well.
He's seeing signs of that weakness, and now would be possibly a good time. Don't wait till September.
Yeah, let's give a listen to what we heard.
Yeah, away from tech, and we've also heard, as we've just been discussing, Fed officials giving conflicting rate cut outlooks for the year. Let's hear.
I believe it makes sense to cut the FOMC's policy rate by 25 basis points 2 weeks from now. And looking to later this year, if, as I expect, underlying inflation remains in check, with headline inflation data reporting modest but temporary increases from tariffs that are not unanchoring inflation expectations, and the economy continues to grow slowly, I would support even further 25 basis point cuts to move policy towards neutral.
You can't wait forever, because if we wait till inflation gets to 2%, well, then we've lost. We've likely injured the economy in some way that was completely unnecessary. And so I'm of the mind that, the summary of economic projections we put out, which had 2 rate cuts for this year, I think that's a reasonable outlook to have.
Given the stability in the employment side of our mandates, with the unemployment rate still at historically low levels, elevated short-run inflation expectations, and goods inflation rising due to the upward pressure from tariffs, I find it appropriate to hold our policy rate at the current level for some time.
Let's bring in Anitza now, head of Asia Fixed Income Research at UBP. I guess you could chime in on this debate, right? Is the July cut justified at this point? And what do you see in terms of?
Well, it's kind of mixed view, right, in the market. As you mentioned, in fact, like the CPI number, the reason the underlying component, we've been seeing some impact from the Asia tariff. So in general, we reckon that cut could happen like in the fourth quarter, not in the July meeting. Maybe we can still see 1 to 2 cut, but I think Fed in general would like to look at some of the data going forward in July, in August, in September to decide the next move. Yeah.
When do you think the next move will likely be?
We reckon potentially it could be 1 to 2 cut, this year, but that would happen, not right now, but probably would be in the fourth quarter.
How do you think about price action right now when long rates continue to be seeing this melt up in yields once again and this yield curve that continues to steepen? How much more further could it steepen, you think?
Well, in fact, when you look at the market, 2 weeks ago, it has been range bound quite a bit. But recently, because of the data, because of, like the market situation, I think, the long end is steepening. So that's why for the 10 years, we'll be very cautious. We reckon that the 10-year could be, reaching around like 5%. It's possible. It's still possible. So therefore, we will advise clients, not trying to put money, to work at the moment for the long end, rather maybe, invest in the short duration bonds. Yeah.
Out here, is there quality credit despite all the noise and uncertainty?
Yeah, at the moment, I think, for most of the investor, what they want to go would be simple, quality credit, something they know, good fundamental. I think that's very important. At the moment, I think in the market, we are still trying to look for some opportunity, for example, in the Bank 81 space, like some of the European bank, because they will be able to offer investor with around like at least over 6% kind of yield. But when you look at some Asian credit, double B Indian names now is around like 5.5, double B. But for some banks, they actually on Bank 81s, they are in the investment grade or high double B with the quality of 5-year, which is pretty interesting, I would say.
How much more tighter can spreads get though?
Well,
right now,
it's a difficult question, to be honest, because at the moment, credit spread has been very tight, but it's also very resilient. There's reasons for that. First of all, if you're talking about like some IG credit at around like 4.55%, it's still relatively decent compared with a few years back, right? But at the same time, demand remains strong, supply seems to be manageable. A lot of the issue, in particular in Asia, are still going for bank loans, and therefore that could limit the supply. So I think at the moment, credit spread could be sort of like range bound, but I just don't particularly think that it could be much tighter from current level.
Where's your diversification play away from U.S. dollar? If we're going to get on an easing cycle, is there going to be those outflows to this part of the world perhaps? And what would be the credit perspective from you?
Yeah, I mean, I think a lot of people are talking about diversifying from U.S. dollar. Our view is also like, a weakened U.S. dollar. And therefore, the thing that we can find in the credit market would be, for example, Aussie denominated bond, because RBA actually, give a pause, last week, right? But at the same time, yesterday, when you see the unemployment rate, 4.3, it's actually surprised the market. So we reckon that potentially RBA may, cut the rate, and therefore with like 4% or 4.5% for some Aussie-denominated bond, I think it's a good investment opportunity outside of U.S. dollar.
What sort of client reception are you getting when it comes to shifting away from U.S. exceptionalism?
I think, people are preparing for that. I won't particularly think that, at the moment people are massively, diversifying away. Again, you need supply from the other market to replace U.S. dollar. At the moment, I think people are preparing for that, looking for opportunity. If opportunity comes, then they will, go for that. But not really, as the first priority.
Yeah. How about Hong Kong, China?
Okay, I think the spread for Hong Kong, China, in particular, like China IG, will remain stable. But Hong Kong, you are talking about property names. Yeah. I think we'll just stick to the investment grade names rather than the unrated one.
Yeah, there's been a few, I guess, names that we won't mention here, but that led to some volatility. Anitza, thank you. Anitza Nip there, head of fixed income research Asia at UBP. Of course, we're counting down the opens of trade in Shanghai, Shenzhen, and Hong Kong. This is the China Show.
And welcome back. You're watching The China Show. Yvonne, we love busy Fridays, don't we? It makes the day go by so much faster to the weekend. We have a busy day today looking at that China stocks rally. Obviously, I've been looking at the CSI 300. It's up 5 of the last 6 days as it's at about 4,034. Hong Kong, of course, been doing pretty well as well this year. Chip stocks definitely in focus. TSMC lifting up that sector, giving a good outlook for AI demand going forward. That's going to be a recurring theme throughout this morning, of course. EV battery makers, maybe a little bit of a different picture. Obviously, the U.S. set to impose about 93.5% tariffs on battery materials out of China. That is going to be an interesting story, which we are going to forensically dissect, of course. Hong Kong dollar, you talked about that earlier today. Testing, well, maybe not testing as hard the low end of that band.
Not as hard, but we're still, after so many, interventions, I mean, things are maybe looking a little bit more stable on that front, but I think most people in the market still think that they still have some ways to go, really. But we're still in that window for FDI data as well. But yeah, we got to check those Asia graphite makers, as Steve mentioned, though, after what we've been hearing, these anti-dumping duties on Chinese imports. And you're seeing an interesting picture there from some of these Korean names as well, like POSCO Future, that's surging some 21%. It's similar to what we saw in some of these Canadian graphite firms that also rallied overnight as well on the back of this move as well. Let's bring in our China correspondent, Min Min Lo, on what's going to be the impact of these new tariffs on the battery as well as the auto industry.
Yeah, so 93.5%, that's just the new tariff. And if you take in the pre-existing tariffs, it will bring the total tariff on graphite products to about 160%. That's according to a trade organization that had submitted those petitions to U.S. federal agencies to start this investigation into Chinese graphite companies. So 160% is a big cost increase for battery makers, especially some South Korean and Japanese battery makers in the U.S. will be hit as well. And of course, further downstream is the EV makers like Tesla. We already saw the stocks there falling about 0.7% overnight in the U.S. And actually, Elon Musk has been one of the most outspoken voices in opposing these tariffs. But even his close relations with Trump hasn't been successful in helping him halt these tariffs coming from the Commerce Secretary. And this chart, you can see, it shows you that about 2/3 of the supply of graphite in the U.S. is coming from China. So it's going to take a few years, according to industry executives, for the U.S. for at least U.S. producers to ramp up production enough to be able to meet the volume as well as the quality required for car makers, because you do need a very pure type of graphite to make the anodes in these batteries. And so it's going to be a big hit for these car makers.
Meanwhile, we have some new data on how Chinese car companies are still heavily underutilized. The overcapacity issues are there, and they are, we've known this, trying to flood the global markets with that excess capacity. At the same time, you're hearing comments from Xi Jinping wondering about whether all the provinces need to go into these policy industries like EVs and AI and batteries and the like. So interesting dynamic happening in China.
Yeah, and I would really recommend you read the story that is out on the terminal. It has a lot of data, and it really shows you how Chinese car makers, as you said, they are operating way below the benchmark utilization rate, which is 70% that is necessary for profitability. So most car makers are operating below that. Top of the ranking is Tesla, operating at very high utilization rate in China. And next is Xiaomi, which is also doing very well after its SUV launched last month, I believe. That saw very strong reception, and the company had to ramp up production. BYD as well, operating at 80 to 86% capacity. But the other car makers, I'm talking about Geely as well as some of the foreign car makers, the joint ventures like Nissan, Honda, or even SAIC, they're operating at 50% or below. And that's why they really need to find these overseas markets. And if you look at this next chart, it shows you all these new markets that Chinese companies are looking at, especially in the emerging markets. Indonesia, for example, the Middle East is becoming an important market as well, looking at 500% increase over the last few years. And that cycle is not even close to the end. Yeah, that's the numbers that you can see, 24,000% for Indonesia, Kazakhstan as well. well. And that cycle is not even close to the end, because even though market leader like BYD is occupying maybe about 27% of the market share, so about a quarter of the market share, but 37% of that market share is being fought over by over 120 companies. So many of them are still trying to wrangle for space in that market. There are still newcomers coming in, although at a smaller pace. So it's still a very intense competition in China, and that overcapacity might be continuing on.
Yeah, these are some study numbers there. Min Min, thank you. Our China correspondent Min Min Lo there with the latest on these tariffs and the like. We're taking a look at what comes to the pre-market in Hong Kong here today. It looks like we could be seeing a pretty punchy open. We're up 1% in the pre-market here. Futures are also heading higher. The open coming up next, and we'll get you a preview. This is Bloomberg.
And welcome back. You are watching the China Show here on Bloomberg. We are counting down to the open of markets and looking pretty positive, especially in the tech space. In Hang Seng there at 24,757. Of course, the sentiment up in the chip space, Yvonne, because TSMC raising the 2025 outlook in a big boost for AI demand. Meanwhile, on the flip side, sort of that on sentiment, the U.S. set to impose some 93.5% tariff on battery materials out of China, and of course the ongoing debate, will they or won't they start easing from the Fed? That's something we're discussing as we approach now the open in 8, 7, 6, 5, 4.
It's like a rocket launch, right, every day. Yeah, there's so many macro themes, right, whether it's the split Fed and how they're thinking about the next rate cut. But, overall, though, the data in the U.S. that we got overnight was actually strong. That's why we did see a bit of an uptick in the dollar. We've come off a little bit on that front here today, but equities continue to carry on and extend this rally globally here, right? After we saw U.S. stocks hit those records. Onshore, we're still talking about a second straight week of gains for the CSI 300, though, as Steve mentioned, the underperformance compared to Hong Kong is still quite wide, but maybe there is still some room for catch-up here as well. You take a look at how Shenzhen's doing. We're doing slightly better there in the Chinex and the Shenzhen gauge there. We're watching very closely what happens when it comes to the tech space in China. Obviously, we talked about crude still doing up about 2%. Commodities are doing quite well. We're actually seeing a pretty big beat and massive bid, I should say, across the likes of iron ore, from Shanghai crude to steel rebar here this morning. So maybe on the back of what we've been seeing has been strong data coming through from China this week after that data dump as well. CATL, that's doing quite well. Of course, we're watching some of the EV space overall, just given what we've been hearing about battery makers, for example, and tariffs there. But we're also focusing on what happens in Hong Kong, right? It seems like a lot of the action still is focused on the tech space. That continues to drive this equity market higher. There you go. HS Tech is up 1.6%. I believe we're still about 2% away. Oh, actually, I'm talking about Taiwan, though. 2% away from the highs and the peaks that were reached for the TAIEX back earlier this part of the year. But TSMC certainly is lifting that and lifting most of the tech space here this morning. You take a look at how the bat is concerned here. Baidu, Alibaba's up close to 3%. Tencent's up more than 1% here right now. Meituan as well. So even the whole concerns about food delivery space and the like, we're brushing those aside here right now. It's really about AI and how that's once again reigniting a little bit this whole AI trade. Since DeepSeek, right? Which really has been a few weeks or months now. So you got to thank NVIDIA for that this week as well. I guess TSMC kind of lit another fire under that here once again. Watching, of course, the EV space. So yes, there's tariffs, but then we're focusing on what's happening with the likes of Li Auto as well. Interesting enough, we're actually seeing it lower at the open. There's a whole new product launch, i8 model. This is the 6-seater SUV. Citi coming through saying that it actually could lead to some pretty strong pre-order momentum here right now. So that could actually be helping the stock, but not today. NIO, though, is doing very well. We're up 6.6% here this morning. And we're watching, of course, as we mentioned, those graphite stocks. So that 93% 2.5% tariff on some of these Chinese battery makers. This is China, sort of the ones that were listed and we're watching very closely. We're actually still seeing some decent gains on some of these particular companies as well. So certainly we're seeing that across the region here this morning. So we'll see what the implications are really on some of these local firms. Yeah. And there you go. Chip makers are doing very well here today. TSMC really helping that as well. We're watching the likes of SMIC up 1.5% today, Steve.
Well, we're going to continue that theme now. A U.S.-based think tank says lithography remains the critical choke point for China's chip making as the country drives, towards self-sufficiency in semiconductors. Joining us now is Jacob Feldgoise, Senior Data Research Analyst at Georgetown University's Center for Security and Emerging Technologies. He's the co-author of their new report. Jacob, thanks so much for joining us here on the China Show. So obviously we had a lot of developments this week with NVIDIA getting White House approval to get the H20 back into China. There's always been debate about China's capabilities amid those export controls, obviously. Where are they catching up and where are they lagging? I guess lithography, advanced lithography, is where you're saying they need catch-up.
Yeah, exactly. So what we saw, we conducted a study and looked at where China's gained market share over the past 5 years in these chip-making tools. And what we saw is that they've made slow, steady progress in many of the major tool categories. And kind of within that, we dug down a little bit deeper, and we saw that within those tool categories, it was really the older, less advanced chip-making tools where Chinese tool makers are making the most progress. And so they're not at the leading edge yet by any means. But the question is whether they'll be able to take those initial revenue gains, pump them into R&D, and move further up the value chain. Lithography, however, was the notable exception, where we really didn't see any major progress at all from Chinese chip makers. And even when we looked at the subsegment with the oldest lithography tools, where you would have expected them to make some progress, we saw basically nothing.
And what does it tell us to you about what, in terms of export curbs, about tariffs? I mean, what has actually worked from the U.S. in maybe curtailing this advancement in lithography, for example? I know ASML still dominates in this space as well. Does the move that we saw this week with NVIDIA now resuming H20 chips to China, for example, is it going to put Netherlands and Japan, are they going to basically not really continue on with some of these export curbs now?
Yeah, so I think the concern has been almost the opposite. The U.S. curbs are not focused on preventing China's rise in equipment. They're focused further down the supply chain, on the fabrication, on the design of chips. But when it comes to the tools, we haven't seen a lot of controls target that sector, target China's progress in that sector in particular. And the concern, again, has been that the export controls further down the supply chain might actually accelerate China's progress further up the supply chain. And so I wouldn't say that we have a conclusive result on whether what we're seeing is a consequence of export controls, but there are some areas that we're watching closely, like chemical mechanical planarization tools, this very niche subsegment.
Well, we're seeing footage now of Jen-Hsun Huang of NVIDIA in Beijing, and his point all along has been these export controls on the H20 and other chips essentially giving the likes of Huawei an unfair advantage and accelerating, as you're alluding to, their progress. But on the equipment and lithography, as Yvonne said, we're talking ASML in the Netherlands, we're talking Tokyo Electron in Japan. There's only a few main companies that make this high-end equipment, which is highly technical, highly sensitive. How far away, if China is looking at self-reliance in the whole chip-making process, are they from getting that expertise, not just, of course, in the silicon and in the chips, but in the chip-making equipment like lithography?
Yeah, they're really far off. We still see very high market shares for U.S. and Japanese firms, and Dutch firms as well. And in some places, we're seeing those firms even further consolidate their market share advantages. Again, the places where we're seeing China make progress are really at the less advanced, older versions of many of these tools. And so they're still quite a ways off. They still have I'd say major self-sufficiency problems when it comes to chip-making tools that, the Chinese government has recognized this for decades, tried to pump money and government support into this space, and they're making marginal gains, but they have a long way to go, I would say.
Why is that, Jacob?
Yeah. How do you overcome it?
China's been able to throw money at problems, and look what they've done in EVs and batteries, in solar and the like. What's the main choke point? Why?
I think there's a couple pieces. I would say subsystems, so the components that actually go into these tools are themselves very complicated, and China is still in the progress of building up their capabilities to produce those subsystems. There's a talent problem as well. You have the people who know how to make these tools, mostly in the United States and Japan and the Netherlands. And then lastly, the technical sophistication of some of these things. I mean, particularly if we look at some of the most advanced lithography tools, you're talking about thousands of components, hundreds of suppliers. It's very difficult to assemble the supply chain to build these things, and they're only getting more complex.
Jacob, just given your research, where we're seeing China gaining ground in self-sufficiency and where we may not in lithography, for example, what are the implications then? What are sort of the sectors and industries that you think that can still thrive under these circumstances?
I would say the implications are that, at least in the short to medium term, when we're thinking about where China is making progress in the AI stack, which is what a lot of what we think about at CSET, it's important to focus on the chip fabrication and the chip design. So this is, for design, Huawei, for fabrication, SMIC, and also Huawei affiliates. But the equipment game is still a long way off. They're still going to be heavily reliant on those foreign suppliers, and their gains, in the AI stack in the short to medium term are going to be concentrated at the design and fabrication stages. Does that help?
Jacob, yeah, it does. Thank you so much. It's great to talk to you more about the research there. Jacob Feldgoise there, Senior Data Research Analyst at Center for Security and Emerging Technology at Georgetown University. Well, coming up, crypto getting a boost from U.S. lawmakers passing Trump-backed legislation on stablecoins and what's seen as a coming of age for digital assets. Well, the details coming up next. This is Bloomberg. We are checking Hong Kong crypto shares and the likes of Bitcoin here this morning. We're actually back above that 120,000 sort of level for Bitcoin. And yeah, it's lifting the crypto space here in Hong Kong today. Huobi Tech, for example, is up some 5%. So this is on the back of the U.S. Congress has passed the first federal legislation to regulate stablecoins, clearing the way for broader use of the technology in everyday finance. Let's get to our cryptocurrency reporter, Subhashri Ghosh. She's with us here right now. How big of a deal is this, and what does it mean for the crypto industry overall?
It is quite important. You can say it's kind of a game changer because the biggest market in crypto, which is in the U.S., has passed this much anticipated legislation allowing a broader adoption of stablecoins to start with, which means that going ahead, the biggest money movers, which are banks, they can kind of allow to incorporate. They can be allowed to incorporate stablecoins as part of their businesses. It's a quite a bit of an important ruling in that sense, a legislation, because it helps you and me and corporates to pass our money across the country and across global regions without worrying that there will be compliance issues. So that's why it's an important legislation that people have been waiting for, traders have been waiting for in the market.
And what does it mean for other countries and regions? Of course, we're in a world of a dollar-denominated system, but again, there's diversification going into stablecoins. And when I was at the World Economic Forum, I asked this question about Hong Kong having its basic sandbox and possibly having that stablecoin linked to the offshore renminbi. And the deputy managing director of the IMF and former PBOC deputy governor Li Bo started nodding his head, saying yes. Yes, it's happening. So how much of a tsunami, if you will, of support in other jurisdictions are stablecoins?
That's a very interesting question and a very hot topic among regulators, like you rightly pointed out, Stephen. It's a dollar-dominated stablecoin market as of now, but we are seeing several parts of the world, including, like you said, Hong Kong. Then we have Singapore, Malaysia, Thailand, a large part of Southeast Asian nations, and of course Europe as well, developing their own local currency regulated or denominated stablecoins. Most of these are, either in the sandboxes or in the pilot stages. So there's a lot of, quite a bit of time until they scale. But everybody wants to, promote and propagate their own currency, and that will be an interesting play we will see, where there will be local currencies, maybe also fighting it out with the U.S. dollar dominance in stablecoins. Of course, the important thing to note over here is how one can smoothly switch between one stablecoin, one currency denominated stablecoin to the other, for example, euro to dollar, or offshore renminbi to USD. That has to be seen as we progress. But yes, stablecoins is the hottest topic because this is the easiest and the fastest way to move money versus, as of now, the fiat money, which we say the usual currency that we see in the global financial regime.
Yeah, it definitely is getting a lot more airtime, of course. Bloomberg cryptocurrency reporter Subhashree Ghosh, thanks for joining us here on The China Show. And we'll have more analysis on the U.S. stablecoin law and the impact for would-be Asian crypto hubs. Singapore and Hong Kong will get analysis from blockchain intelligence firm TRM Labs and the head of Coinbase Singapore on Insight later today with Haslinda Amin.
And now to some other corporate headlines this morning. Wells Fargo is said to have suspended employee travel to China after an Atlanta-based trade finance MD was recently barred from leaving the country. The employee was born in Shanghai. A source says that's led the bank to restrict travel for other staff. In a statement, Wells Fargo says it's working through appropriate channels to bring her back to the U.S. Netflix beat expectations across the board in the second quarter, posting revenue of $11.1 billion. It also raised their full-year guidance, forecasting $45 billion in sales and a near 30% margin. The company's market cap now exceeds $500 billion as it leans into content and ads amid rising global competition.
All right, well, Yvonne, Japanese Prime Minister Shigeru Ishiba-san is set to meet U.S. Treasury Secretary Scott Bessent in Tokyo later today, just before his government faces a crucial upper house election on Sunday. Japan politics and economics reporter Sakura Murakami joins us now from Tokyo. So, Sakura, what can we expect from these talks? Obviously, there's been some contentious back and forth between Washington and Tokyo about the possible tariffs. What can Bessent say and do that will make a difference this weekend?
To be honest, there's not a lot we can expect from the talks today. There'll probably be more of the same, which is probably working towards a mutually beneficial agreement. This is mainly because Prime Minister Ishiba is in a very difficult position with the elections coming up this Sunday, and that puts him in an awkward position of having to, he can't strike a bad deal, but so in this case, it's probably better to have no deal. So at this point, on the face of it, Secretary Bessent is in Tokyo, and he will be visiting Osaka probably later this week to attend the World Expo, and that's the main purpose of his visit. So it might be awkward for Japanese officials especially, but that's what we can expect at this point.
And the timing of it is quite interesting, right? Just ahead of this upper house election. So do you think Bessent's visit will impact these elections in any way?
So at the moment, there is real concern about the impact the tariffs will have on the economy. But in terms of the polls and the general public, about maybe 8-9% of the people are saying that the results of the tariff talks will impact their voting and how they'll vote in the ballot, how they'll cast their ballot. So it's not to say that there is no impact, but people will be concerned, and especially the optics of it is going to be interesting as well. If Bessent and Ishiba meet, and Prime Minister Ishiba comes away without any strong message or any kind of real progress seen, it's going to not look so great for him with only 2 days until people actually cast their vote as well. So the optics of it will be something people will be looking for as well.
Well, Sakura, how tenuous is Ishiba-san's mandate to rule? There's been a revolving door of prime ministers, of course, in Japan for a long time. Shinzo Abe was sort of the exception there. But does a lot hang in the balance for him with this, obviously with the U.S. relationship, but with this upper house election?
Yes, for sure. I mean, at the moment, he's ruling with a minority government. He had a bit of a bruising defeat last October when he couldn't quite win the majority. And so he's been, with the minority government, he's been making a lot of concessions with the smaller opposition parties. The opposition parties haven't really galvanized around a specific leader to bring down Ishiba at this point. So that's also partly because these trade talks are ongoing, and it's going to be a bad look for Ishiba if there isn't a strong leader who's sort of spearheading these talks. But that being said, polls show that approval for Ishiba and also the ruling Liberal Democratic Party is looking not great. A recent poll put approval for Ishiba at 20%, which is quite low. And by Sunday, when the results come out, we might be looking at potentially Ishiba standing down or soldiering on, but also with a lesser mandate.
Yeah, Sakura, it's going to be a busy weekend for you, it sounds like. Sakura Murakami there, our Japan politics and economics reporter. Joining us out of Tokyo, we got plenty more ahead. This is Bloomberg. All right, we're checking some movers here this morning. It remains the TSMC, the big story of the day here with what they've been seeing, raising their revenue outlook and the like on this whole AI boost here. So that's reinvigorating this whole AI trade. TSMC shares are at 2%, and I believe we're around those record highs, if not higher, right now. We're watching the whole supply chain of TSMC as well, all looking decently, slightly higher this morning. But Asia chips, that really is where we are seeing it, spread regionally here. But it's a mixed picture, right? Yeah. Take a look at SK Hynix, MediaTek, that's doing well. Tokyo Electron and Samsung, though, head the other direction, Steve.
Of course, we're going to continue to be digging into the TSMC earnings with Murray Asset Global Investments in the next hour. Plus, we're going to hear later from TSMC's Senior Vice President and Chief Financial Officer, great get there, Wendell Huang, speaking exclusively to Bloomberg about the company's forecast and tech tensions between the U.S. and China. So lots to chew on, obviously. We'll have a lot more in the next, on the way, of course, in the next hour. You are watching the China Show as we approach 10 o'clock in Shanghai and the Orient Pearl Tower from our offices in Lujiazui. This is Bloomberg. And welcome back to this Friday edition, the second hour of the China show. As you can see, the Hang Seng up, buoyed by tech sentiment right now after the TSMC upgraded outlook. Chinese Commerce Minister Wang Wentao set to speak there at the country's 14th five-year plan. About to take the dais there. Obviously, the next five-year plan, Yvonne, is going to really be centered around self-reliance, self-sufficiency in the face of ongoing trade disputes with the likes of the United States.
Well, interesting to hear what he says about what he assumes in terms of tariffs. I mean, obviously, we're getting closer to that August deadline there in China. And certainly, this week it's really about the NVIDIA story, right? And that's really kind of, I guess, eased up some of the concerns around where U.S.-China trade tensions are moving forward. In terms of the market impact, we talked about the Hang Seng. We're near those session highs. We're about 1% to the upside there for Hang Seng. And we're talking about a second straight week of gains, possibly when it comes to the CSI 300. We're watching the healthcare space. That continues to be quite hot as well. There was a line coming through from J.P. Morgan and their team saying that, there's still some catalysts that are well positioned to continue outperforming even after this rally that we've seen in the healthcare sector, right? So they're talking about, it's this strong momentum and the out-licensing deals of these innovative drugs, the solid fundamentals of China biotech and pharma companies there that really leads to a very favorable domestic policy environment there as well. So there you go. Another day where we are seeing healthcare outperform. And then it's still that TSMC effect here. TSMC is still up some 2% for the stock here, and that is helping to raise all their suppliers and tech shares overall in the region.
Yeah, rising tide lift all boats, and TSMC, the biggest contract manufacturer in chips, the foundry in Taiwan, definitely raising sentiment, not only just their outlook. TSMC shares, they are higher in Taipei after it raised its sales growth projection for the year to around 30% in U.S. dollar terms, but CFO Wendell Huang warning that the appreciating Taiwanese dollar would probably depress third-quarter business.
Fluctuations in the exchange rate between U.S. dollar and NT will have a sizable impact to our reported revenue and gross profit margin. The sensitivity of the revenue to dollar-NT exchange rate is nearly 100%. That is, every 1% appreciation of NT against U.S. dollars will reduce our reported NT revenue by 1%.
Wendell Huang speaking there, and NT, of course, is new Taiwan dollar. Let's bring in Edward Chan, portfolio manager and senior investment analyst at Murray Asset Global Investments. Thanks so much for joining us. So, first of all, just your first reaction to those results and, of course, the guidance going forward.
Yeah, so I think TSMC delivered a great set of results. If you look at the second quarter, the revenue came in even ahead of the high end of their guidance. And I think the third quarter top-line guidance of the midpoint 8% sequential growth is also ahead of the low single-digit expectation from the street. And also, I think the gross margin guidance also hold up really well, consider that, we just now saw the CFO saying the headwind from the NT dollar appreciation versus the U.S. And I think that's really quite a big factor for TSMC if you think about the gross margin impact, because majority of their revenue are in U.S. dollars, and yet more than 70% of their cost of sales are in NT dollars, right? So, that appreciation in NT dollars really has a material impact on the margin. We're seeing they're guiding over 200 basis point of impact in second quarter and also in third quarter. And so I think without those impact, their result would have been a much stronger beat, versus what we're seeing now. But they also lift the full year guidance as well, from 25% to a 30% year-over-year growth in U.S. dollars terms.
It still seems to suggest, though, that there might be a bit of a softer revenue decline in the fourth quarter. Obviously, with tariff threats and the like, how big of a deal is that? Do you think, are they just simply being too conservative?
I think a lot of analysts are drilling on the fourth quarter, right? Yeah. Because if you look at the past 5 years, typically the sequential growth in the fourth quarter is normally at least flat to positive. Certainly not your typical seasonality to see the fourth quarter revenue go down sequentially. But I think management is just being quite prudent here. They've cited potential tariff and macro impact, so they always want to be a little bit more conservative on their guide.
What do the results tell you about the continued momentum in the AI space? Obviously, there's also been news this week about NVIDIA getting the H20. We can talk about that separately. But generally speaking, how does this basically reflect that continuing AI demand in the West as well as in China, which sort of segues as well into that H20 chip from NVIDIA discussion?
Yeah, I think coming into this quarter, I think the tone sounds more positive versus the last quarter. Last quarter, a lot of people were concerned about whether CoWoS could be a little bit oversupply, going into 2026. And then management's comment were maybe the demand supply is more balanced in 26. But this quarter, they emphasized on just trying to match that demand, catch up on the demand supply gap. So I think definitely the tone on the AI momentum is more positive this quarter.
How do I position? Do I focus still on the big names, the big cap tech, or do I look at more broadly now at the whole AI supply chain?
Yeah, so I think you have to look at a little bit of both, right? Because the big cap are still, if you look at the infrastructure investment, are still going full ahead of steam in terms of the infrastructure investment. We're hearing gigawatts AI data center being announced, right? So I think in terms of the capex momentum is still very strong. So infrastructure names like the TSMC, NVIDIA still benefits. And then in terms of the broader based tech and AI, I think a lot of enterprise are already integrating these models into their workloads, but it will take time for us to see that benefit.
How much of an impact will there be with the, I guess you could call it a relaxation of the export controls on the NVIDIA chips, the AI accelerators, the H20 into China? What does that mean as well for a company, a contract manufacturer like TSMC, as NVIDIA also is coming up with their other chip architecture that was going to comply with the Trump previous export controls based on the Blackwell RTX 6000 Pro chip. So you have kind of two AI accelerators potentially going into China and being made in Taiwan.
Yeah, so I think first thing is that the H20 is already right at the limit of what is allowed to sell into China, right? So in terms of the spec now, it's hard to imagine, under the regulation, you can't really have another chip that goes over that current spec. And then in terms of the new architecture that there's a lot of chatter in the market about, I think the advantage is that you're having potentially under a new architecture Blackwell, where you could potentially have other benefits of moving to a new architecture. So I think most likely two products might exist side by side, depending on the customer needs.
Does it change how you view overall the whole tech supply chain and between U.S. and China? I'm just wondering now that NVIDIA has gotten the green light, does that open a whole sort of opportunities for you as a stock picker on what companies might benefit and what industries might benefit from this?
So I think it's not really a big green light in that sense, right? Because it's still under quite a lot of restrictions,
sure.
And H20 spec is heavily restricted versus currently the latest that we could buy in terms of Blackwell. So I don't think it's a drastic shift, from the previous policy from that standpoint. And I think certainly marginally there are benefits. NVIDIA might get an extra 10-20 billion US dollar revenue for the end of the fiscal year, and then that gets a little bit of boost for the whole supply chain, but I don't think anything drastic has changed after
the
this.
NVIDIA stock is still your key holding, though.
Yes.
You're still willing to hold this stock despite where valuations are and the like. Is there more upside then for the stock?
Yeah, so I think at the moment we think the whole sort of infrastructure investment momentum is still ongoing. And I think if you look at the options that companies have, right, NVIDIA is still one of the primary options that they go to. I mean, we're seeing more activity on the ASIC side. I think there's a lot of projects that are going on. Companies are trying to do their own custom chip. But for now, I think the bulk of that volume will still come from NVIDIA, and therefore they'll benefit from that.
Does the fact that Jen-Hsun Huang is in Beijing, he came there as well with the basically tacit approval from the White House that he can start selling it. Has China sort of moved on, or is the supply chain for AI development, the DeepSeek moment that still has legs, does it still need those accelerators? I mean, we're talking about Jen-Hsun Huang, and NVIDIA says by blocking the H20 in April was potentially going to cut about $8 billion from their revenue in this current quarter. Yeah. How much of a game changer does the relaxation mean for NVIDIA?
Yeah, so I think it's always an ongoing process, right? And on one hand, you have China, or you have different types of startups that are trying to do these accelerators and trying to fill that gap that maybe NVIDIA left after the sanction. And then you have, on the other hand, I think companies are still trying to buy anything they can, right? Whenever NVIDIA is willing to sell. And I think that's a sort of parallel track that companies will work on whatever hardware they could get their hands to and train the models that they can do.
We're about to actually speak to the CFO of TSMC. I'm just wondering, if you had a question to ask him, what would you ask Wendell Huang right now?
Yeah, I think they're less willing to sort of look more forward into 26. So probably more of the advanced packaging capacity and their outlook into 26 will be an interesting one.
All right. Edward Chan, Portfolio Manager and Senior Investment Analyst at Murray Asset Global Investments. Thanks so much for your insights. And we'll hear from the TSMC Senior Vice President and CFO, Wendell Huang, later, speaking exclusively to Bloomberg about the company's forecasts and tech tensions between China and the United States. Yvonne?
Yeah, turning to more markets and beyond just the TSMC space, let's bring in our Bloomberg MLI strategist, Mary Nicola, who she joins us now from Singapore. Mary, we're wrapping up to be a pretty good week when it comes to risk assets. There's also the whole Fed debate and whether, what Waller just mentioned a few hours ago about maybe a July sort of cut is justified. I mean, what's top of mind for you as you wrap up the week?
Yeah, it's interesting to see how the narrative and the debate is ongoing between a lot of the Fed members. So you had Williams, who was saying that he's looking to take a pause and just see how things unfold. And then, of course, we had retail sales numbers showing us that the economy is holding up and is relatively robust. And I think overall what that suggests, especially to equity markets and investors, is actually quite positive. So even if we see a delay in Fed rate cuts, because Waller seems to be on the path of we should look through tariffs, which is very different from a lot of the narrative from the rest. But I think the focus here is if the economy is still holding up well and the earnings are unfolding in a positive manner, then that's actually positive for equities. And it's not going to only be a ripple effect and have a positive impact just on U.S. equities, but it's likely to ripple through to global equities as well. And I think one thing we have to keep in mind through this earnings season is that the bar is set quite low. So it's important to look at what the earnings outlooks are for a lot of the companies and what they're expecting, especially how they're reading a lot of the tariff noise. But so far, I think even if you get a delay in tariff in Fed rate cuts, I think that there's overall positivity in equity markets because of the fact that the economy is holding up.
Yeah, speaking of those ripple effects, how many ripples do we still have potentially as we go into a positive weekend, obviously with the tech, influence from TSMC and also NVIDIA this week. But also we're getting really into the nitty-gritty of the potential deadline of August 12th for that China-U.S. extension, if you will, of their goodwill, their truce, and the talk of a potential grand bargain, Trump dealing with China. Is this kind of tech momentum just kind of a symptom of what is potentially a grander story that we're going to be talking about in the coming weeks as we head towards the doldrums of August?
Well, I think in general, you're seeing the underlying fundamentals still quite strong. So as we saw what we saw from NVIDIA, what we saw from TSMC, next week we have Google also coming through. So a lot of those earnings are going to actually build to that. And really what matters is the fundamentals. Are the fundamentals still pointing to a strong direction? And are they are they suggesting that the AI space and tech space is still quite strong? And then add to that some of the policy tailwinds that we're going to likely get, or we are getting from China. So China has been on the policy side, has been very supportive of the tech industry, and obviously the tariffs and the spat between the U.S. and China trade tensions still loom, especially with the deadline, as you suggested. But again, there are some signs that the relationship is improving. There are suggestions of talks coming through, and obviously all those policy tailwinds will add only to that momentum. But really, when it comes down to it, we still have to see that the fundamentals are well anchored and that the earnings are still solid.
All right, Bloomberg MLive strategist Mary Nicola, thanks so much for joining us. Well, let's get back to Beijing, where Chinese Commerce Minister Wang Wentao speaking at a briefing there. He is talking about, well, the whole preface of the press conference is about the next 5-year plan in China. He says he's hopeful to see retail sales exceed 50 trillion yuan in 2025. Domestic consumption, obviously a huge priority of the top leadership in Beijing, and surely for the Commerce Minister there, Wang, as he is also, of course, dealing with the external shocks from that trade war. So any insight we can get from him on any potential grand bargain from the United States would be very interesting. But clearly, they need to boost domestic consumption to offset some of the export shocks.
There was a state council meeting this week. The readout was pretty dry, but they had this term again, Steve, domestic circulation, right? We've been talking about dual circulation for many months now here as well. So we'll see what that means when it comes to the retail sector and really overall the consumption space. Goldman Sachs is going to be joining us to talk a little bit more about that coming up. We're going to leave these pictures there for Bloomberg subscribers, though. You can check it out at LiveGo. Just recapping some of the inflation numbers that we got at Japan here earlier this morning. So still looking elevated, though we have eased off from the 2-year high when it comes to prices there. But certainly is going to be keeping pressure on Prime Minister Shigeru Ishiba ahead of that Sunday national election. The JGB market, though, right now, we're seeing a little bit of a bid across some of the long end of the curve for now. But, people are, we take a look at the traders and what they're really forecasting with this upper house election. If, in fact, we see a sense of this majority that's being lost, and really what this means for economic policy and government spending, this is going to lead to maybe even a potential triple dip in Japanese JGB bonds. So certainly that's one thing to watch here as we get closer to these elections, Steve.
Yeah, and the yen's not showing much confidence at 148.44 to the U.S. dollar at this moment. Japan's Prime Minister Shigeru Ishiba will meet U.S. Treasury Secretary Scott Bessent today ahead of Sunday's upper house election that we've been talking about. Bloomberg Opinions' Geroid Brady joins us now. Geroid, Ishiba's failure to steady trade ties with Washington could be his final misstep. That is the headline of your latest piece. He's in sort of a no-win situation, right? He can't give too good of a deal to the United States at a time when, of course, his mandate's pretty weak right now.
Absolutely. It's a tricky situation for anyone. And as you say, he's in a trickier situation than most, with a minority government, an election coming up that is already polling quite badly in, and the situation that you have in Japan at the moment. The reason that I have, that headline on the column that you mentioned there is because there is a contrast to be had between how Ishiba is doing and the extraordinary efforts that was done under the late Shinzo Abe, who obviously was Ishiba's great rival over the last 15 years within the LDP. Abe was able to do things maybe we shouldn't expect normal politicians to be able to do, but famously he was able to contain Trump, to form a relationship with Trump back when people had no idea how to deal with him and no idea how to handle him. Ishiba hasn't been able to replicate that at all. And a couple of months ago we were talking about the hope that Japan would get a quick trade deal. Here we are, 3 months down the line, and Japan is just being treated pretty much like any other country and not as the, lockstep partner for the U.S. that it has been in the past.
Yeah, I still remember those pictures of them playing golf together and the like, and the warm embrace that the U.S. and Japan had back then under Shinzo Abe. But tell us a bit more about why you're seeing such lack of popularity in the LDP party here right now. Is it just on what we're seeing, the external threats with trade tensions and the like? But what's really happening domestically, do you think, in Japan?
There's a number of factors. There's obviously inflation is one of the large factors. You know, Japan is not used to having inflation, and even the relatively mild inflation compared to some other countries post-COVID has been a shock to a country that is basically used to the price of things going down year on year and real spending power increasing over the last 20 years. That's one factor. There's also the lingering effects of the LDP funding scandal that was, it's over 2 years ago now at this stage. But I think the number one factor that you're seeing is that a lot of the conservative voters who would typically vote for the LDP are quite disillusioned, and particularly disillusioned in Ishiba. Ishiba comes from a more liberal wing, or perhaps the most liberal wing of the LDP, even though, it is a conservative party. He is on the more liberal leaning side of that. And he really hasn't displayed much leadership. He's been very disappointing since he came in terms of his electoral results. He was elected, if you'll recall, back in last September. The idea was to replace Fumio Kishida with a leader who would be able to call an election, restore the LDP's mandate, and stabilize politics. And really, he's done exactly the opposite. And if polls are as bad, if the vote is as bad on Sunday as polls are looking, that's going to get even weaker going into next week.
So if he gets absolutely slaughtered at the ballot box on Sunday, does he potentially resign, or does he go the opposite way and say, what the heck, I have nothing to lose, I'm going to strike a deal with the U.S.?
There's definitely potential for it to go both ways. I think traditionally you would see, and we have seen this in the past, that an LDP leader who would have had, if they do as badly as polls suggest on Sunday, 3 disastrous elections in a row. There was the lower house vote last year. There was recent Tokyo Assembly elections where the LDP really got whipped, and the upper house election that we're going to have on Sunday. As leader, Ishiba would be expected to take responsibility for this, but we are in a bit of a tricky situation within the LDP. There's a bit of a leadership vacuum at the moment. His rivals may not want this moment, particularly with the threat of tariffs hanging over them, to take over or to try and oust him and try to take over at this time. And then he may also, there's been reports this week that he may also use the threat of tariffs. He was very quick to term this, when they were first imposed, to term it a national crisis. So he may say, well, hang on, we can't be having this power vacuum in the midst of this national crisis when we haven't even reached a deal with the U.S.
Right.
It's going to be very interesting. Thank you so much. We're already there, our Bloomberg opinion columnist, on what to expect really leading up to this upper house election in Japan. Plenty more ahead. This is Bloomberg. It's a slow news day, so we're taking stock here this morning when it comes to what's going on, this eye-watering rally when it comes to Chinese bank stocks, right, that we've had this year. Well, part of the appeal was the dividend play, obviously, but now it seems like they might be losing that sort of attraction, right? Take a look at the evaluations of some of these banks here right now, and we're actually seeing them trade above book, which we haven't seen for some time. So are things looking a little bit pricey? You also saw the likes of some of the insurers like China Life recently also trim some of their holdings of some of these banks as well. Why? Maybe the rally's gone too far. Also, when it comes to dividend plays, the yields have actually been falling. So maybe there's less of a need to really kind of dive into this sector, but it really has been more of a defensive play for many that are also leaning into maybe the growth stocks, that barbell strategy. One thing to look at, though, when you take a look at the financial sector moving forward. Plenty more ahead. This is Bloomberg.
Oh.
11:29 a.m. in Tokyo. Japanese markets heading to that lunch break, and it is, of course, the election eve, or at least the penultimate one leading up to that upper house election. So there is some angst maybe leading up to this. We were just talking about how, Bessent's in town there as well. So if we ever see, if in fact a trade deal with Japan and the U.S., what does that mean for the likes of Ishiba-san here this weekend? Certainly that's a lot at stake here. Dollar yen not doing a whole lot. We're at 148 levels here right now, but expect maybe a bit more angst least in the long end of that JGB curve, Steve.
Yeah, you know, we're also looking at China right now. We've been dipping into Beijing, where we have the Commerce Minister, Wang Wentao, speaking about the next 5-year plan, but he's talking a lot about consumption and retail sales. He's been saying that he'd like to see retail sales exceed 50 trillion yuan this year in 2025. And he sees Chinese retail sales on a purchasing price parity basis at 1.6 times the United States. So again, there's optimism that they can rebalance the economy and sort of absorb some of that excess capacity that they are exporting. But again, it's a long road to hoe to get the consumer confidence going again.
Yeah, it certainly still seems to be the key question. I think we were just talking to Hui Shan this week about, is there more animal spirits there when it comes to boosting consumer confidence and the like? That's one of the key questions that their clients are asking as well. Goldman Sachs recently also talking a bit about the unexciting consumption backdrop that we're seeing in the space here right now, and really talking about these price wars and almost a lot of these subsectors in the consumer space. Let's bring in Michelle Cheng. She's co-head of Asia Consumer Research, and she joins us here right now. It's interesting, though, when you take a look at just the price wars that we're seeing, it's almost in all the sectors in the consumption space here right now. You're saying we could see more downside in terms of the pricing risks. Where?
Yeah, so if you recall, I think earlier we mentioned that when we are seeing consumption bottoming out in fourth quarter, first quarter, we were seeing pricing stabilize. But it's true that from second quarter, you have like BYD cutting the price, and then into the June 18 promotion activity is still very elevated. And we also see the platform, internet big giants, they are initially issuing good consumption coupon to drive the consumption, but then it looks like they further step up this competition, the level of the competition, and then it definitely dragged the pricing. So at this moment, we see basically across the board, pricing are under pressure. No matter it's apparel, seeing they still have some inventories to digest. You have spirits that's partially impacted by this alcohol ban, and it's also seeing weaker demand, so that drag down the pricing. So it's true that I think from the quarter-over-quarter trends, we see the risk. But having said that, second half last year, actually consumption was pretty bad. This is when the government started to push out the stimulus, and the base should be slightly easier. But originally, I think some companies are looking for maybe their stabilization and they can drive a better growth into second half. But now we still have a hope that the growth rate will be better than first half. But I think the acceleration, the magnitude might be smaller than what we expected.
So what's going to be the catalyst to end this 33-month straight run of factory gate deflation? Also, CPI is just around zero anyway right now. There doesn't seem to be a lot of catalysts coming forward on the calendar. Maybe 11/11 Singles Day in November. Aside from cash handouts from the government or a policy shift from Xi Jinping where he's saying no more price war in EVs, what's it going to take?
Definitely, I think it goes back to the confidence level. So I think earlier when we see price more stabilized, on the one side, I think consumers have probably confidence level bottom out. So they are slightly more willing to pay some, not necessarily premium, but pay a reasonable price for the good quality product. But on the other side, I think at that time, the competition landscape is slightly better because I think some merchants, even they do a lot of promotion activities, they couldn't really bear the cost. So this is actually one of the angles we talk about restaurants industry competitive landscape slightly improve because this actually squeeze out some of the weaker players. But at this moment, I think it's a bit complicated since there's the support from the platforms, and this makes things a little bit complicated at this moment. Some weaker players, they stay, they can still survive. So I think hopefully we still want to have a more a reasonable competitive landscape so that the good guys, good quality companies, they can benefit.
How do you boost this whole domestic circulation theme then? I mean, do you expect these trade-in programs, could it actually widen to cover a wider range of products? And there's also some chatter about subsidizing services as well. Do you foresee any of these happening anytime soon?
If we quote our macro team's comment, I think there could be still more like targeted support stimulus. So you actually see that the trading policy work reasonably well. So if you look at retail data, headline number members is still resilient and trading. Even there's some monthly volatility, but that sector actually support the general retail sales. And also you see that birth support and also safety net improvement. But at this moment, we don't really see a broad-based, large-scale stimulus. Yeah.
How do investors read what you're saying, and how do they basically benefit from it?
Yeah, so that's why this year there's been a big theme in the consumer space, new consumption versus traditional consumptions. And new consumptions partially is those sectors really exploring the white space, and partially is some newly listed company, but the quality companies being listed. And so investors, they can have some new ideas they can explore. And so I think, although I think there's increasing debate on the new consumer names, given expectation has been moving up significantly, and they are debating into next year. But I think all in all, when investors invest in consumer space, they always like growth. So if a company can still deliver reasonable, like 20-30% plus growth, this is, I think, still the area people will focus on. Versus for the old consumer or traditional consumer space, actually it's not all that bad, although generally it's not as exciting as before, but we still see some quality good companies, market leader, if they can have a agile business model, they continue to enhance the efficiency, they still have a good opportunity. And last but not least, I think balance sheet, shareholder return, for the traditional names, if they can have a steady earnings and they are willing to return the cash flow to the shareholders, I think this is still the bright side.
The big news this week was what we heard from PopMart, right? That guidance of 350% surge in profit. I mean, how important is, I mean, the whole international expansion side of things here? I know you're looking at overseas demand, for example, for some of these companies, right? Where Labubus have basically gone global in some way. How important is that theme moving forward?
Definitely, it's important. Starting from around like 2 years ago, we tried to study the opportunity for Chinese brands going global. I think initially the Chinese brands are getting more attractions domestically. But if you look at Japan's experience back in 1990, why quite a few consumer companies can get bigger and bigger, even domestic consumption was weak, it's really going global. But among the Chinese companies going global, I think there are actually two stages. In the very first stage, we see a lot of success leveraging their supply chain. So no matter it's white goods company, handset companies, they are all sitting on a very strong supply chain. But indeed, we are starting to see another wave. Hopefully, is the branding going globally. And so the IP company is an example. Hopefully, some jewelry company is an example.
Well, Laopu is one on the buy list, right? The gold company, and gold projected to go even higher. So what are some names that you can reveal?
Yeah, so on the one side, from the sector perspective, for those sector we like, definitely the structural growth opportunity, white space to go. So those IP retailer companies or even pet food companies, this is also area see a lot of opportunity. And sportswear, I think to some extent they still have volume growth story.
But is one that's listed here.
Yeah, and beverage company, this is also the space, and restaurants. Yeah, and the company level, I think definitely it become more diverse even within the sector. So if a company can really provide the different product and in the right brand cycle, it will be good.
All right, Michelle, thanks so much for coming in and talking about a great subject this Friday, consumption. I'm not going down the Labubu path just yet. Michelle Cheng, co-head of the Asia Consumer Research at Goldman Sachs. All right, coming up on the show, how Chinese factories are struggling to cope with Trump's tariff tirades. Our team at Bloomberg Originals explores what companies are doing to stay in business. You're watching The China Show.
Well, tariff chaos is shaking global supply chains and forcing Chinese manufacturers to rethink their strategies. Bloomberg Originals has been exploring whether they're truly eyeing a shift to production in the U.S.
Navigating high-risk environments when you can't see what's ahead is no mean feat. But it's the kind of uncertainty Donald Trump's trade actions have forced on China's factory workers.
President Trump ramping up trade tensions again.
The word tariff, music to my ears.
So we're in the realm of just endless tit for tat.
This just kind of indicates how much of a moving target this has really become.
At stake is hundreds of billions of dollars in bilateral trade and access to the world's single largest consumer market, backed by American spending power.
This trade war basically leaves no one untouched, whether that's investors, business people, or officials in any country.
It just seems like every manufacturer in China realizes that they need to have strategies in case things get worse.
Two things are becoming clear, though. One, that finding a replacement for the mighty US consumer is as essential as it is difficult. And two, that despite all the tariff chaos, Chinese manufacturers aren't rushing to shift production into the US.
Americans don't want to make spatulas. They want to eat hamburgers. And I don't mean that in a negative way. I want to eat hamburgers too, but I'm here in China making the spatulas to do it. Americans don't want these jobs. And to think that manufacturing would go back to the United States is a farce.
Chinese manufacturers have had to get used to living with uncertainty.
They're not looking at their strategy 5-10 years down the line. They're looking to keep their factories open for the next few months.
And that's costing money and clients.
Typically, we'll do about 150 to 160 million in revenue. This year, we're down about 20%. Our customers are essentially on pause.
Even exporters of incense destined for yoga studios, people you'd expect to be pretty zen, are fretting over demand.
12月份到5月份这个期间呢，我们所有的工厂的这个生产是停滞，然后我们的所有的人力成本还需要去做额外的一些支付。
You probably know why.
We really need to change the way trade works around the world.
We basically saw in April that the U.S. and China traded these tit-for-tat tariff hikes, which raised tariffs up to 145% for Chinese goods going to the U.S. and 125% for U.S. goods coming to China. In mid-May, we saw those tariffs reduced.
Still, Trump continues to make threats, including against countries that help China sidestep tariffs. Trade between the two nations has risen steadily for the last 25 years.
We're looking at basically $600 billion worth of goods traded between the two nations last year.
And with that has come a ballooning trade deficit. In 2024, the US imported nearly $439 billion worth of goods from China. But US exports to China totaled little more than $143 billion. That's about a $295 billion difference, or trade deficit.
One country actually said to me, I was amazed that we were able to get away with it for this long.
While the US administration argues tariffs are the best way to address trade imbalances.
The Chinese manufacturers, they don't understand why the U.S. is doing this. For a lot of Chinese exporters, it's going to be a lot more costly, a lot more difficult to sell to the U.S. market going forward.
The concern is that companies that will no longer have access to their biggest export market will then need to cut prices, let go of people, there'll be lower wages, and that's going to dampen consumer sentiment. Consumer confidence in China is already at historic lows because of this prolonged property crisis where a lot of wealth is tied up.
Despite all the uncertainty, the latest data shows China's economy appears to have held up, despite a slump in trade with the US. China's gross domestic product expanded by a better-than-expected 5.2% during the second quarter of the year. While exports to the US fell 24% in the second quarter, China's overall exports rose over 6% during the same period. But the country is facing persistent deflation, meaning companies are earning less money and making them more reluctant to invest and hire.
Although China has signaled this intention to shift to a more consumer-driven economy, it still really depends on its manufacturing sector to be able to meet its growth targets.
As uncertainty around Trump's tariff plans persist, manufacturers, workers, and their families are stuck in limbo and bracing for the worst.
Although Chinese exports to the U.S. account for something like 3% of GDP, once you take into the secondary effect, the loss of jobs, lower wages, potentially price cuts to get rid of inventory, then we're looking at a much worse situation and potentially a deflationary spiral.
And so, with Trump's trade assault whipsawing relations between the world's biggest economies, China's manufacturers are grappling for options. For one thing, US businesses and distributors who buy goods manufactured in China need time to plan orders. At Velong Enterprises, a manufacturer in Guangdong, Jacob Rothman says this hasn't been possible.
这个有点刮伤了。
等一下我们留意一下了哈。
好吧。There are buying cycles, and they only happen once a year. And shipping for those categories, no matter what it is, are regimented to those shipping cycles.
On again, off again US policy has been confusing too. Trump's 90-day delay following his so-called Liberation Day tariffs didn't help companies like Jacobs.
He was saying how his staff let out a big cheer when they heard about the reduction. Later that evening, his U.S. customers called him and said they were still upset.
They didn't know where to place their orders because we're too late for the previous season that they missed product for and too early for the next season. So where do they place their orders?
About 700 miles to the west, outside the city of Kunming, Jonathan Wang runs Shantyvale, an incense brand. The family business has been producing their products by hand for more than a decade.
They have their own workshop, their own farm, and over the last year or so, Jonathan has decided to export to the U.S.
本来我们是预计今年年初的时候就想进入到美国市场的，但是由于特朗普政府然后的关税政策不断的变化，我们一直往后延期。关税开始有一些变化的时候，我们就开始故意放缓了我们出口的这个脚步。那么包括工厂这边的产能，我们也是做了这个调整，然后不要那么多。
He was also hit by Trump's closure of the de minimis tariff loophole, a Latin term meaning too small to matter. It lets small businesses ship low-value packages duty-free.
那么在小包裹的这个政策，然后取消了以后，然后开始慢慢的有更多的关税的新闻出来以后，我们会发现说，我们没有办法在小包裹的这个运输上面去留给我们自己足够的利润空间。
In an effort to sidestep the evolving tariffs, many companies in mainland China have adopted a so-called China Plus One model. India and Southeast Asia have benefited in particular.
Our first factory outside of China was in Cambodia, and it was during President Trump's first term. And it was really to test if we could project our manufacturing beyond China. Since 70% of our goods go to the United States, we did have to, of course, make cuts to our manufacturing staff.
We've seen a pretty big exodus to Southeast Asia to take advantage of those lower labor costs, but also for the proximity to Chinese raw materials.
We have no choice. So even within this year, our Cambodian factory doubled in size. So did our factory outside of Delhi. And our factory outside of Mumbai is adding new manufacturing space now.
We've already seen exporters look to emerging markets or other developed markets for those goods that they're no longer able to sell to the U.S.
30% of our volume is going to Europe. Presumably, we could say, well, let's stop U.S. business, right? Let's focus on Europe. But then you have every single company and manufacturing firm focusing on a smaller market. Competition becomes even more fierce for Europe.
我们的确有考虑过要放弃美国市场，然后看是否转战欧洲或者东南亚市场。但是我们会发现，欧洲那一边它其实市场已经相对成熟了，它有自己比较丰富的一些香薰产品。
It's very hard to replace the U.S. consumer. It's the biggest market, and the American consumers are very open to new ideas and trying new trends.
There's just no way that China can fill that volume of exports quickly, whether it's emerging markets or developed countries. But in the long term, they're hoping that these emerging markets will provide a way out.
There's no quick replacement for the U.S. market. The spending power of the US consumer is so strong, even with tariffs, Chinese companies are not wholly scared off. Instead, it's about managing an uncertain relationship and planning for the worst.
So the conversations in Beijing, whether it's among officials, business people, academics, it's not really about how to rebuild the relationship with the US. It's about managing the decoupling and how to do it in the least painful way possible.
Great stuff from our China team there, as we can see. And subscribers can see that documentary right now on the terminal or at Bloomberg.com. It'll be available later on the Bloomberg Originals YouTube channel.
Yeah, and we're checking some of these graphite stocks here in the region here this morning. This is on the back of what the U.S. Commerce Department imposed, these prelim anti-dumping duties of 93.5% on graphite, which is a key battery material, right? You're taking a look at some of these Korean names, the Australian names as well are basically surging. POSCO Future up 18%. Saira over in Australia also up about 17% this morning. We got plenty more ahead. This is Bloomberg.
Well, Chinese Commerce Minister Wang Wentao still speaking off and on in Beijing in a briefing on the next 5-year plan. He has acknowledged he has met with visiting NVIDIA CEO Jen-Hsun Huang. Obviously, Jen-Hsun Huang is there for a supply chain conference, but he's really there to meet with the likes of Wang Wentao as well as He Lifeng, especially after announcing NVIDIA did that the meeting he had, Jen-Hsun Huang, with Trump last week netted him a resumption of exports of H20 chips into China.
Yeah, so certainly getting that bit of reprieve there for NVIDIA, but it's a big win for them in the mainland as well. So certainly that's one thing to watch. Obviously, on the back of that whole NVIDIA story is, of course, their supplier, TSMC, which really has lifted a lot of the sentiment here in the region here this morning. The TSMC stock is at records now. Yeah. We're seeing gains of 2% or more. Our interview is coming up next. A lot of questions to ask the CFO, Wendell Huang, not just about the whole AI sort of demand picture, which CC Wei, the CEO, did really highlight. That's still very strong. But the FX side of things here and the currency headwinds moving forward. Yeah, that's right. Absolutely. And what is going to be the outlook for 2026 because of all those headwinds? We won't know, and they didn't give a 2026 outlook. That's it from us here from the China Show. Insight with Helena Amen. We're going to bring you that interview coming up next. This is Bloomberg.